Is AI overhyped? The $2.5 trillion reality check. Seth Klarman, the billionaire investor once called the Oracle of Boston, just issued a warning that should make every AI investor stop and think. He said today's AI-driven market has characteristics of a bubble. And he's not alone. In a single two-day period, nearly $1.3 trillion was wiped off the Nasdaq as valuation concerns snowballed. So the question isn't whether AI is real. It is. The question is whether the money pouring into it, over $660 billion in infrastructure spending alone projected for 2026, is chasing reality or chasing hype. Let's break down what the numbers actually say. NVIDIA is worth $5 trillion. OpenAI is valued at $500 billion. Global AI spending is projected to hit $1.5 trillion. And yet, according to the Federal Reserve, only 18% of businesses have actually adopted AI. That gap, between the trillions being spent and the reality on the ground, is what legendary investor Seth Klarman called a bubble. Let's break down what's really happening. What if AI is simultaneously the most important technology of our lifetime and a financial bubble? Those two things sound contradictory, but they're not. And the data proves it. B-roll suggestion. Stock chart animation showing Nasdaq volatility, NVIDIA stock trajectory, then quick cut to Seth Klarman photo or news headline. The trillion-dollar gap. Here's where things get interesting. For the past 2 years, the narrative has been simple. AI is the next industrial revolution. Companies that don't adopt it will be left behind. Investors who don't get in now will miss the biggest wealth creation event in history. And, to be fair, there's truth to that. AI is already transforming industries from coding to healthcare to scientific research. Models like GPT 5.5, Gemini, and GLM 5.2 are genuinely powerful. This isn't vaporware. But here's the thing. There's a massive gap between what AI can do and what companies are actually doing with it. And that gap is where the bubble lives. Let's look at the numbers. According to McKinsey's 2025 Global Survey on AI, 88% of enterprises say they use AI in at least one function. That sounds like mass adoption. But when you dig deeper, the picture changes dramatically. The Federal Reserve's own research shows that only about 18% of U.S. firms have actually adopted AI as of the end of 2025. Not experimenting with it. Not running a pilot. Actually adopted it. That's the real number. And the ROI? According to a 2026 enterprise survey, nearly half of companies, 48%, call their AI adoption a massive disappointment. That's up from 34% the year before. Only 29% report significant ROI from generative AI. And for AI agents, just 23%. B-roll suggestion. Animated bar chart showing 88% claimed adoption versus 18% actual adoption versus 29% ROI. The visual gap tells the story. The dot-com echo. Now, here's the question nobody is asking. Does this sound familiar? In 1999, companies were pouring billions into internet infrastructure. Valuations were soaring. Everyone said the internet would change the world. And they were right. The internet did change the world. But a lot of investors still lost everything because they were right about the technology and wrong about the timeline. Forbes published an article in May 2026 with a title that captures this perfectly. AI can change the world and still be a bubble. And that's the core tension we need to understand. Think about it. Big tech is projected to spend around $660 billion on AI infrastructure in 2026 alone. That's data centers, GPUs, energy, cooling systems, networking. An enormous capital expenditure. And much of it is being financed with borrowed money. Meanwhile, OpenAI is reportedly valued at around $500 billion. Against 2025 revenue, that implies something on the order of 110 times trailing sales. To put that in perspective, that multiple sits above Tesla and rivals some of the most expensive valuations in market history. This isn't just investment. It's speculation. And in technology, speculation without adoption always corrects eventually. B-roll suggestion. Side-by-side comparison graphic. .com era metrics versus 2026 AI metrics. Similar trajectory lines. The deeper reality. What's actually working? But before we declare the whole thing a bubble, it's important to remain realistic. Not everything in AI is hype. There are areas where the technology is genuinely delivering. In software development, AI coding tools are producing measurable productivity gains. Models like GLM 5.2, with its 1 million token context window, are enabling autonomous coding workflows that simply weren't possible 2 years ago. Open-source AI is accelerating faster than anyone predicted. In scientific research, AI is being used for drug discovery, protein folding, and materials science, with real, published results. These aren't demos. They're breakthroughs. The problem isn't the technology. The problem is the gap between what the technology can do in a controlled environment and what enterprises can actually deploy at scale.
Here's why.
Most large organizations run on legacy systems. They have tight budgets, real operational risk, and compliance requirements. They can't just plug in a language model and transform overnight. The McKinsey survey found that while 88% of enterprises use AI somewhere, actual production-grade deployment, AI integrated into core business processes, remains rare. One analysis described this as the doorman fallacy. Companies looked at the visible output, writing code, generating text, and assumed that was the whole job. But the hard part isn't generating code. The hard part is the invisible work. Understanding business context, managing edge cases, maintaining systems, handling security, dealing with integration. So companies invest millions in AI projects that produce demos but not products. Pilots that never scale. Dashboards that look impressive but don't change the bottom line. B-roll suggestion. Split screen. On one side, an AI demo generating code. On the other, a complex enterprise system diagram showing integration points, legacy systems, compliance layers.
Mid-roll CTA.
If you're finding this breakdown helpful, subscribe and turn on notifications. We cover the real numbers behind AI, not just the headlines. The gap between what's promised and what's delivered is where the real story lives. And that story is just getting started. The investor perspective. Who's warning who? Now let's go back to Seth Klarman, because his warning matters more than most. Klarman isn't a tech commentator. He's one of the most respected value investors in the world. His firm, Bopos Group, manages nearly $19 billion. He's often compared to Warren Buffett for his disciplined, patient approach. When someone like that uses the word bubble, people listen. Klarman said the AI-driven market shows characteristics of a bubble, specifically pointing to what he called new era thinking and sky-high multiples despite massive uncertainty. That phrase is important. New era thinking is exactly the psychological pattern that precedes every major market correction. It's the belief that this time is different, that the old rules don't apply, that valuations based on traditional metrics no longer matter because the technology is too transformative. And that belief, historically, is what inflates bubbles. Not fraud, not stupidity, genuine excitement about real technology, pushed past the point where the numbers justify the prices. But here's the critical nuance. A bubble doesn't mean the technology is fake. The dot-com bubble didn't mean the internet was fake. The housing bubble didn't mean houses were fake. It means the capital allocation got ahead of the reality. And right now, AI capital allocation is significantly ahead of AI adoption reality. B-roll suggestion. Animated timeline showing historical bubbles, 1999.com, 2008 housing, 2026 AI, with the new era thinking call-out at each peak. What happens next? Correction versus crash. So what happens from here? There are two scenarios, and the data supports elements of both. Scenario 1, a correction. Valuations pull back. Companies that have been spending billions on AI infrastructure slow down their capital expenditure. The AI premium on tech stocks compresses. This is already happening. The $1.3 trillion Nasdaq sell-off in a single 2-day window was a signal, not a one-off event. Markets are beginning to reprice AI expectations. Scenario 2. The adoption gap closes. AI tools get cheaper, easier to deploy, and more integrated into enterprise workflows. The 18% adoption figure climbs. ROI improves from the current 29%. Companies that invested early in AI infrastructure start seeing returns. The bubble narrative fades because the fundamentals catch up to the valuations. Here's the reality. Both of these things are likely to happen simultaneously. Some companies and sectors will see real AI-driven transformation. Others will discover they spent billions on infrastructure with no clear path to returns. The market will sort between the two, and that sorting process is going to be painful for the losers. The companies that win won't be the ones who spent the most on AI. They'll be the ones who solved the adoption gap, who figured out how to turn AI capability into business value, who moved past the demo stage into production. And for investors, the lesson from every previous technology cycle is the same. The technology always wins eventually, but the timeline matters. And right now, the timeline between investment and return is being measured in years, not quarters. B-roll suggestion, fork path animation. 2 diverging roads. 1 labeled correction, 1 labeled adoption catches up. Both leading to the same destination. AI transforms, but not on the schedule the market priced in. So, is AI overhyped? The answer is yes and no, and that's the most honest answer anyone can give. Yes, the technology is real. Yes, it will transform industries. Yes, we're in the early innings of something genuinely historic. But also yes, the valuations have run ahead of adoption. The spending has outpaced the ROI. And the gap between what AI can do in a lab and what enterprises can deploy in production is wider than most investors want to admit. Seth Klarman saw it. The Federal Reserve's data shows it. The enterprise ROI numbers confirm it. The $1.3 trillion that vanished from the Nasdaq in 2 days is the market starting to price it in. This isn't just another tech correction. This is the moment where the AI narrative has to collide with the AI reality. And what happens next will determine whether we're looking at a bubble that bursts or a bubble that the fundamentals eventually grow into. Do you think AI is overhyped, or are we just early? Let me know in the comments. If you enjoyed this breakdown, don't forget to like, subscribe, and turn on notifications because the AI race is moving faster than ever, and the gap between hype and reality is where the real story lives.